My name is Mirna Marovic. Today is designed to be practical and senior, especially for those of you on a partner track or already in a partner seat. The key idea for today is not just raising money, it's positioning, proof, and process run with discipline. A quick note that works well for the large virtual group that we have today. Please use Q&A function for questions and comments as we go on. We'll also use VooClap, which is akin to Slido, for live questions and polls. Those are anonymous and fast. And because the room is mixed in the fundraising experience, we will level set quickly and then move to the advanced tactics, so that everyone can follow and that the more experienced practitioners still do get a value. Now, I would like to invite Carmen Vera Garcia, Senior Advisor at Financial Institutions, Advisory Division, European Investment Bank, to provide us with welcome remarks on behalf of the Empowering Equity Mentorship Plus program, which is a joint initiative of European Investment Fund, EIF, European Investment Bank, EIB, and European Union under the InvestEU Advisory Hub. Carmen, the floor is yours.
Thank you very much, Mirna, and welcome everybody to the first open webinar of the Empowering Equity Initiative under the Mentorship Knowledge Hub. I see some names and some faces that are known already in the screen, but for those who are new to the Empowering Equity, this initiative was launched in 2022 by the European Investment Fund with the collaboration of EIB Advisory and, as mentioned earlier by Mirna, financed by the European Commission, the InvestEU Advisory Hub. And we launched this initiative with one main objective: to promote diversity and women leadership in venture capital, private equity, and private credit. And in fact, since 2022, the initiative has been growing. It has brought together both investors, but also institutions that are committed to working together in making the European Union investment landscape much more diverse. And indeed, it has started to become a growing community. Besides the Empowering Equity annual events that take place every year and where this community meets regularly, we launched last year the Scale Up Mentorship Plus program. And now, well, with this new open webinar, we intend precisely to create a new avenue of collaboration, of peer learning, so the community can keep growing and, let's say, keep working together for this shared objective. So with this, just to say, we hope that you engage today, but also beyond this webinar, that you follow us. And well, in fact, we're looking forward to learning and to hearing from you. So with this, once again, thank you very much on behalf of the European Investment Fund, the EIB Advisory, and also the whole Empowering Equity team. Thank you very much, and over to you, Mirna.
Thank you so much, Carmen Vera Garcia, for this welcome remarks. And I would like now to introduce a bit our format for today and my co-facilitator. So you are going to also hear from Valérie Offray later in the session during our fireside chat. Valerie is partner at Corval Partners, and she has 20 years of experience in investor relations and fundraising. She has founded Corval Partners in 2025 to advise emerging fund managers and independent sponsors on fundraising strategy and execution. Previously, she was the partner and head of UK Trivago, and before that, she was also head of investor relations at Apostolic Capital, and she has led 3 fundraisers from inception. So you're going to hear from both. You will get a little bit of fundraising framework from me, and then Valerie's practical perspective, what we are seeing from the LPs right now. So think of this as strategy, story, and a system. And what we would like you to have by the end of today's session is first a clearer and more market-aligned fundraising strategy, how to sequence, how to pace, how to target. Second, we want you to be able to stronger position yourself, how to articulate differentiation in a way that actually survives the LP scrutiny. And third, a practical skill for assessing and sustaining relationship across LP types, institutions, family offices, and other non-institutional capital. So let's move to the agenda slide. So the plan for today's flow will start with a quick calibration and then a snapshot of the market backdrop using the latest European fundraising statistics. And then we will move on to the fundraising roadmap, what the process really looks like end to end, and what LP increasingly expect in materials, due diligence, readiness, and targeting. And after that, we will transition into the fireside chat section with Valerie, and when we will convert theory into what actually works with LPs in real life. So let's calibrate quickly so we can pitch our level correctly. So please try to open your phones and scan the QR code, which will allow you to vote via Book Club, which is akin to Slido, works exactly the same. And we are interested to know, what best describes your fundraising exposure. Are you new to fundraising? Have you supported a raise already, led parts of the raise, or led the full raise? And if the technology allows us, we should be seeing the real-time answers on our screen. Let's hope we can do that. Right. And let's see if people are voting. Perfect. Lovely. Right. Okay, so we'll give it, a few more seconds. It seems that we have a mixed level of experience in the room, but it seems that the overall participants are skewing towards A and B. So we will slow down slightly on some definitions and mechanics, and then bring you quickly into the more advanced part. Thank you so much for doing this first interaction. This, for us, is important just to calibrate. So let's move into the fundraising snapshot for Europe. So this is a context slide. The simple message for 2005 that, fundraising has been, possible, but the bar is higher. Default yes has disappeared. LPs are more selective because liquidity distributions have been very, very uneven, and portfolio concentration is real. So many LPs are prioritizing existing manager relationship. Success in fundraising comes really to three things: differentiated strategy, credible evidence, and institutional grade execution. So what this European fundraising snapshot shows is we are showing the absolute, we are not showing the absolute fundraising volumes. Instead, we decided to sort of index the level of fundraising success. The value 100 is set at the beginning of a 10-year period, 2015, and it is showing venture capital, private equity, and private credit strategies. Despite those markets are very different in size, it allows us to have a little bit of view on everything. So we start with venture capital. We can see a very pronounced cycle. Fundraising peaked during the pandemic years, driven by booming technology valuations and strong public market comparables. But since the peak in 2002, it has really gone down and collapsed. Now, very interesting fun fact, or actually a sad fact, is that 2005 fundraising for venture capital in Europe has been lower than in 2015. This is a very important reset to internalize. For private equity, we observe a similar direction, but a much less severe decline. Fundraising has come down from peak levels, but it has remained structurally more resilient, supported by out strategies, operational value creation, and longer LP experience with these asset class, generally also perceived slightly less risky. By contrast, private credit shows a very different pattern. We do not see the same post-pandemic collapse. Fundraising has remained relatively stable and in some segments structurally strong, reflecting higher interest rates, bank retrenchment, and LP demand for yield and downside protection. A critical caveat is scale. Those markets are not comparable in size. To put things in perspective, in 2025, total European fundraising was approximately 12 billion euros for venture capital, 81 billion euros for private equity, and 51 billion euros for private credit, excluding real estate, infrastructure, and special situation turnaround credit. So we are using PitchBook data to have up-to-date statistics, even though we really value Invest Europe figures, that those, however, have not yet been available for 2025. I just want to note that the European figures include UK, and which does impact to the great extent the European Union figure, and it also includes Israel. Let us, everybody is going to get the slides, which also in the subsegment annex part includes very detailed statistics, which you can then review. Let's go to the next slide, please. Let's make now this context extremely practical. We want you to go again on the Hook Club, which is similar to Slido, scan your code, and answer the following question. What is your number one fundraising constraint today? Is it the LP access? Is it differentiation? Is it track record, attribution, or proof? Is it DD readiness or operational due diligence? So we'll give it a few more seconds for everybody to be able to answer. I see that the answers are coming in. Still about half of the group is voting, and it seems that two of the predominant answers seems to be A and C. So if the LP access is your top fundraising constraint, your fastest then would be usually a targeting discipline and a tighter outreach strategy. And the C option, which is about the track record, being a top constraint, then you need to build an evidence pack that removes the doubt, and that is not an easy thing. Right, I think that we are going to close now this interaction, and we are going to move towards the fundraising process end to end. So we want to move from the market context to the operating reality, the fundraising roadmap. The point of this section is to make fundraising feel less like an art and more like a system that you can run. When you run it as a system, you reduce the time in the market, you reduce friction in diligence, and you increase conversion. Let's move to the slide with fundraising cycle. And this slide is very important because it places the fundraising inside of the broader fund life cycle. A typical closed-end fund runs over 10 years, and fundraising is the first gating event. No capital means no portfolio. No portfolio means no track record progression. So fundraising is not really an isolated activity. It sort of sets your investor base, it sets your operating bundle, and it sets credibility to carry on towards the fund 2, fund 3, and so on. And this is why today it's not just about how to create a system that wins repeatedly. In today's environment, the section which is called the investment period, the exit, the distributions, the DPIs, they materially affect your re-up behavior and the success of winning your LPs. When DPI is lower or is zero, exits are delayed, LPs have less capital coming back, and this is directly what reduces their ability to re-up, and even if they are happy with the fund manager. So this fundraising implication is very practical. Pacing takes longer, ticket sizes can compress, and LP decision making is more portfolio timing driven. And this is in today's environment, this is what we are especially seeing in the venture capital market, but across all the alternative investment strategies. So let's move to the next slide, when we would like to define what is fundraising. And we want to provide a very clear definition. Fundraising is the process of securing capital commitments from LPs through structured marketing, diligence, and documentations until first close and ultimately final close. And I want to underline one point. Fundraising is also financing your firm as a going concern. The operational readiness and your credibility are not just nice to have, it's the department of the investment product that LPs are underwriting. Fundraising has got also very clear milestones. First, there is pre-marketing, then is first closing, intermediate closings, and then moving towards the final close. Pre-market is occurring all the way to the first close. And this is where you validate your message, you build your target list, you start early conventions, and work towards a credible first close. And after the first close, the fund is launched and the official marketing process begins. You scale outreach, you run more a formal due diligence process, and drive commitments toward the successive closings. First close really matters because it allows you to start investing and creates a credibility momentum. It's a validation of your strategy. But many raises are won and lost also in the period subsequent to the first close based on your execution, follow-up, and due diligence responsiveness. So from GP perspective, fundraising is both capital raising process and an execution process. And planning your runway, keeping your message consistent, and managing diligence in a professional way. One practical way to think about is you are underwriting two things at the same time: fund commitments and the management company platform that must deliver the strategy for the next 10 years. And this is all the target, fund size, and the fee economics are strategic because they determine whether the platform is sustainable. And let's go to the next slide, which provides you a very useful mental model in this presentation. So fundraising is not one track. It is the three work streams run in parallel. The investor work stream, targeting, outreach, meetings, diligence, closing, the evidence work stream, track record, pipeline, case studies, your why now and your risk narrative, and then your institutional work stream, operational due diligence readiness, providers, compliance, ESG reporting, governance. While many emerging managers struggle is they overinvest in one stream, usually investor meetings, while the other two streams slug. So LP felt that imbalance immediately. So many managers fail not because the strategy is bad, but because they run only the work stream number one. So to make this very practical, every single LP meeting generates questions that test the work stream number two and the work stream number three. If your proof is not ready, you can't answer convincingly. If your platform is not ready, diligence is stale. So the goal is not more meetings, it's a conversion. And conversion comes from running all the three streams with the disciplines. Operationally, it helps you assign the owner to each stream and run it with a weekly cadence. So you can have a pipeline of the LP meetings, proof items to blend, and operational due diligence items to close. Otherwise, you will fall behind in one of the work streams. Let's move to the next slide. So fundraising is also has got a staged architecture. The key shift in today's market is that LPs increasingly decide no based on the due diligence readiness signal, not only on the returns. So the goal is to have a coherent set of materials that progress logically, a strong top line deck and positioning, and then the deeper proof, track record, attribution, case studies, then the data room that can stand up for institutional due diligence. That, as you know, a narrative, an evidence, and verification. In practice, LP screen very, very quickly at the beginning. Your presentation and positioning is what should get you to the second conversation. But what gets you through the second conversation into the diligence is proof, attribution clarity, case studies, portfolio logic, and consistency of numbers. And what gets you through the due diligence is readiness, clean documents, fast responses, and a data room that feels institutional. One simple rule is that your material should answer why you, why now, and why believe in you. And they should do that consistently across presentation, due diligence questionnaire, and the data room. LP often interpret messy or for due diligence as a proxy for future reporting and guidance quality. So let's do a little interaction to test one of the most misunderstood mechanics. If you can please scan the WOO Club QR code and answer which statement is the most accurate. So first close happens when the first commitments letter is signed. B, after first close, economics can change freely. C, first close equals to sufficient commitments to begin investing. Terms largely stabilize thereafter. And the final close in is when fund wins down. So let's give it a little bit of chance that people answer this. And we test a little bit the knowledge. So I'm actually really happy that almost 90% of you are choosing the correct answer. So first close is when you have sufficient commitments to begin investing and terms largely stabilized there. So that's if you have selected the wrong option, doesn't really matter. This is why we are doing this roadmap. Mechanics do matter because LPs judge, professionalism partly to the process discipline. But I'm very happy that the class has selected most of the right answers. Right. Okay, let's move on to the next slide. And we want to say, this is where we want to say where targeting becomes strategic. So not every LPs is compatible with every fund stage. As fund one opportunity is very different risk proposition than a fund 3 and fund 4 and fund 5. And a family office decision process is structurally also very different from a pension fund or insurer. So segmentation comes before targeting. If you skip segmentation, you are wasting time on the LPs who cannot say yes, even if they like you. Segmentation means to decide upfront what fit looks like to you, and strategy fit, the fund size and the ticket size, the geography stage, and the LP ability to back emerging managers. It also means understanding a little bit the decision mechanics, the speed, the committee structure, and what they require from you from a platform perspective. This is not a theory. This is how to avoid spending 6 months with the wrong LP universe. Let's go to the next slide, please. This slide shows a simple scoring model that works. Targeting is fit times probability timing. So timing, fit is, do they invest in your strategy in your stage? Timing, are they allocating now or they are full for this vintage? And then probability is a real path to a meeting and a decision. So the important point is that these factors multiply. If one is weak, the whole opportunity becomes a very low conversion. This is why chasing a prestige LP with low probability and bad timing is usually poor use of your time, even if it looks perfect on paper. So the sequencing matters. So start with, returning LPs, warm network, then anchor capable LPs that create credibility, and then broaden your outreach once your material and data room are tight and you have the momentum. So this sequencing is, the most effective way to improve conversion rates without working twice as hard. Right. So I am very happy that I'm just on time towards the end of this first section, and we will now open the floor towards the questions at this stage. I will probably need a little bit of help from my colleagues because while delivering the presentation, I wasn't able to monitor the questions. Do we have a question that needs to be answered? Right, so will you be sharing the pitch deck at the end of the session? Yes, this pitch deck will be shared together with an annex section, which we do not have time to cover. Is there any other questions that we should raise now? So I want to just, if there are no further questions, we will move on to the fireside chat. But I would like to encourage all the participants to actively use question and answer, because there will be a question and answer session, at the end of this presentation. So maybe shall we see if there is a more question?
Right. So there are two more questions that have
there are two
been
more,
published.
which I don't.
Yeah, one
I don't see them on.
One from Ugo on how long it takes to be ready to set up a professional data room, and one from Serena on what do you think of the use of AI in the process?
Mm-hmm. Okay, so I can actually combine these two questions to answer. So I think in today's environment, we really can use AI to advance the process of preparing due diligence answer and to set up the virtual data room and the requested document. However, I would like to warn everybody that this is there are also some confidentiality issues which I don't want to enter. So if you want to upload everything in GPT, that may not be a super good idea, especially if it's not coded, if you provide full names and details and everything. Secondly, the use of AI can be detected both by machine and both by a trained human. So it sounds a little bit bad if the AI has written you the diligence answer or prepared your documents, although on the surface it can look very professional, but somebody who is a trained professional can actually spot it. In terms of how much does it need to build the complete set of virtual data room? It really depends how much experience you have and what is the strength of your team. It is a multidisciplinary exercise, and if you have never done it, it really probably is going to take months, because it needs to be very carefully, tweaked and positioned, and there is a lot of documents. Some suggest to start with the ILPA questionnaire, which is the basic institutional International Limited Partners Association, ILPA, like the most broader standard. But many LPs use their own variants of various due diligence questionnaires, and and in order to prepare various phases of the strategy which are needed today, and may include, your reporting capabilities, your capability to report, on sustainability, regardless of not having sustainability position, that will be, that can take time. Right. Okay, so with these questions, I think we can just now move towards.
We do have a few more questions, Mirna,
okay,
and we do have time for those.
Okay, perfect.
I think that we have
I don't see them.
One question from Priyanka on how we can find out which institutions are allocated in a specific year, versus if we should not use our time reaching out if their allocation for that year is already exhausted. Another question is, maybe I read 2 or 3 of them and you give one.
Sure.
And then you mentioned that this is from Andra, and you mentioned that not every LP type is compatible with every fund stage or structure. To avoid spending time with the wrong type of LP, what are some good practices that you can share for this aspect?
Okay, so it is very, very difficult to get an inside information if you don't know the LP, you don't have a chance to have maybe an informal conversation, perhaps during a conference, or somebody has introduced you. What specific strategies are they supporting? This is usually not a published data, so you will not say, oh, we are completely full with our venture capital allocation, or we are not looking anymore at 2026 vintage because our previous 5 years have not delivered any DPIs and exits. This is something that somebody will tell you in person if they like you. Otherwise, you won't get it. Sometimes this type of knowledge is available to somebody who has an extensive network and a good relationship with a broader universe of LPs, such as advisors or placement agents. What you can get from some data, if you have quite expensive subscriptions like Brekin or PitchBook, what has been the past investment decisions by that particular LP, but that could be available only if you have access to this commercial data vendor platform. Unfortunately, there is no great deal of transparency in the private capital market. Any other question, or we move towards the fundraising?
I think we can move forward.
We move forward, and then we can still, tackle your questions. Please keep on posting questions. We will have another question and answer session. So it is my, great pleasure that after this, first more theoretical framework, I can invite Valerie, partner at Coral Partners, to join me with the fireside chat. As I have introduced her initially, I'll just repeat, she has more than 20 years of fundraising and investor relations experience in both advising fund managers and having led fundraisers from inside the GP platform. And today she does work with emerging fund managers and independent sponsors across positioning, LP engagement, diligence, and closing. Valerie, thank you for being with us. We'll keep this very practical and candid. for the audience, please, continue using question and answer. And we'll also be continuing using the book club pulse check during the discussion. So let's move to the very first question toward the fireside chat. And to frame it, it helps us remember that LP evaluates funds through a structured portfolio-driven lens, not in isolation. Valerie, what do LPs care about most when they access a fund manager?
Thank you, Mirna, and good afternoon, everyone. So first of all, I think Mirna touched upon it. You need to understand that not all LPs are the same. They all have different investment constraints. They all have different investment processes. For each LP, you need to understand, where they are with their private equity or private market allocations. Are they underweight or overweighted, which means can they invest or can't they invest? What are the portfolio construction needs? What are they looking for at the moment? And what is the investment process? So what's the due diligence style? What is the decision timeline? Who is actually making the decision? Is it a committee? Is it a one person, for family offices? And in practice, most LP adopt a mixed approach between what we call the top-down approach and a bottom-up approach. So top-down approach is really much interest rate raising. I should be investing in a private credit fund because I'm underweight on private debt. So let me map, manager in the space and find GPs that I can back in that space. Or, the markets are really volatile. Healthcare and technology have been, in high demand and stable and resilient. Again, should I increase my allocations to these fund managers? Or, in Europe, Spain is doing quite well at the moment, and I can look through my funds manager and my underlying companies and can see that actually, I don't have much Spanish exposure and maybe I should increase it. So that's the top-down approach. Other LPs, and typically more family offices LPs, have bottom-up approach where they say, I don't mind. I only interested in GPs who can deliver me 3x return. And it doesn't matter if most of my portfolio is going to be in healthcare, or is most of my portfolio is going to be in, I don't know, the UK or the Nordic region in Europe. I'm doing my bottom-up approach. So in practice, most LP will actually combine, these two approaches. So you will have a top-down and a bottom-up approach where they look at the portfolio construction and are looking for what is missing and trying to find, a GP where they can build high conviction. So one of the key points here is, sometimes you will have a decline from an LP, and it's not because of you, it's because of them. And that's what you need to understand, the difference between a decline, which is because something was not quite right in your offering, or if the decline is actually nothing to do about you, but it's more about them. So I would say to maybe to sum up, when you enter into a meeting with an LP, always ask, descriptions of and ask for explanation of their investment strategy, the private equity program, so you know how you will fit or not, and also make sure that you're able to you're able to build a good case to fit the needs. I mean, LPs always look at something that they don't already have, so you need to bring them something that they don't have. So that's the one of the key things to remember in the way LP think.
That's a very perfect summary. Thank you so much, Valerie, for this contribution. And I would now like to invite two mentees from the current cohort of Empowering Equity Mentorship Plus program and give floor to Anela Memešević-Stefić, also mentee of current cohort. Anela, if you can please briefly introduce yourself in the same way, your location, role, fund manager, and share your experience engaging with LPs, including the main challenges you're facing in fundraising. Again, about 2 minutes. Thank you so much.
Thank you, Mirna. I hope you can hear me all well. And hello, everyone. I'm a VP in HCB. This is a mezzanine fund investing in SMEs across Croatia and the SEE region. This is actually our first fund raised by a first-time team. Our journey had two key phases, first with EIF and Croatian Development Bank, and the second with other LPs. The process with EIF was highly structured with clear milestones, and our role was to respond to due diligence and show that we could execute our strategy, as you previously mentioned as well. In parallel, we engaged with other regional investors, but honestly speaking, discussions became truly meaningful only once EIF and HBER commitments were confirmed. In our experience, once you pass EIF due diligence, you are really well prepared for discussions with other LPs, since their processes are largely aligned with EIF standards. LPs focused on two core questions always. Does the strategy address market gap, and can the team deliver? For us, one of the biggest challenges as a small first-time team was resources, because we were managing at the same time multiple LPs, parallel due diligences, side letters, and KYC process, which was surprisingly very challenging for us because we are coming from Croatia, our investors mostly coming from Croatia. But overall, fundraising took almost 2 years, and I would say that key lesson was to prepare investors early for the whole process, and we are really grateful for their patience. And finally, I want to share with you a short story from our first close. Although we were still missing one key document, we decided to take a risk and book flight for the first board meeting in Luxembourg, because we didn't want to miss the deadline for the first close. And luckily, the document arrived just before the start of the meeting. And in the end, this reminded us that even with perfect structure and organization, fundraising can still come down to only one document and the decision to get on the plane. Thank you.
Thank you so much. This was a great experience. Thank you both, Daniela and Anela, for sharing your experience. And, you know, we are now going to move to another interaction via WOOP Club. What makes a pitch credible? So please scan your QR code. And this time we would like you to enter one single word. What makes a GP credible to LP? Let's try to show the real-time the results on the screen. Okay, so we have reputation, experience, evidence, success. As you know, we are looking at this word cloud. I would like to ask for our expert here, Valerie, which two words do you think you mostly want to see? And which common word do you think can be misleading without evidence behind it? Valerie?
Yeah, so maybe are we waiting for the end of the WOOP rule, or is finished?
It will be coming in. You can already pick if you see two words that you particularly like and one word that is misleading, regardless of the size of the word.
Regardless of, okay. There's a lot of interesting things in there. So let's go on the evidence. You know, I think LPs react really poorly, actually, on unsupported statements. So, you know, things like all these buzzwords where we have a strong deal flow, or teams are, you know, deep expertise, or we have a hands-on approach, or, you know, so when you pitch to an LP, it's really important to support and evidence your statement. You use examples, especially when you know, you go through your case studies. Use the case study to illustrate every single aspect of your investment strategy, the sourcing, the, you know, your edge in winning that deal, why it was a good deal for you, and all the value creation aspect on it. So always support your statement, and the reason is LP needs to believe in, you know, that you have a recipe or a mechanism that will allow you to repeat the success that you had in the past. So it's like, you know, understanding that you have a methodology for generating a superior return. So evidence, definitely a key one. What else do we have? Yes, transparency and openness. I mean, LP don't expect perfection, you know, especially with emerging managers. So they like you to be realistic and self-aware of your limitation. They like to understand, you know, what you learned from the past and past mistake, or bad deals that you may have made in the past. They want to understand how, you know, how you mitigated a departure of a key person from your team. They need to understand why, you know, the strategy has evolved versus what you've been doing before. So transparency and openness and being upfront about it, I think it's definitely a big plus. Things where I would maybe be more less candid on is reputation. I think reputation sometimes can be misleading. There's not misleading, but there's you know, or get the wrong representations where people think, oh, they come from a great well-known firm, but is your strategy at that well-known firm and your approach is really different from what you're now planning to do. You know, don't just rely on your reputation. It can open doors, but it doesn't necessarily serve you later on if there's inconsistency in what you've done.
Lovely. Thank you so much, Valerie. And now we will make this practical with a quick ranking exercise on who is most likely to consider a first-time team in Europe. So again, if you can please scan this QR code with your mobile phone and rank the LP types from most to least likely to consider the first-time fund. Family offices, endowments, development financial institutions or DFIs, specialist funds of funds, pension, insurance, and sovereigns. And thank you. And then as Valerie, as the results are coming in, what surprises you the most and what would you change depending on whether the fund is in venture capital, private equity, or private credit? Let's maybe wait for a moment to get the actual results. How does it look like, the ranking? Do we see it? It's very small for my screen. Most frequent combinations. Okay, so we have here quite different combinations, but if you just see the first two choices, pension fund insurance, specialist funds of funds, or development financial institution, specialist fund of funds, and then family offices, specialist fund of funds. These are what I can actually see as the most frequent combinations of the first two targets. What surprises you about those results, Valerie?
Well, to see pension funds and insurer ranked first, I think it's quite unusual, but again, it depends of your strategy. And if you're a private debt or private credit fund, it is true that institutional investor like pension fund and insurance intends to invest more heavily in private debt and private credit. But that's actually quite surprising to see them as early LP target. They intend to be quite conservative in their approach. They like to see really stable team, long track records, and they're really slow. So they're not necessarily the type of LPs I would prioritize in my list. And again, with the exceptions of maybe for private debt and private credit funds. The things I will just comment on is that your best target and your best first close LP and the first backer of your strategy are the people and the LPs that who know you from your past experience. So it's can be institutional LPs, it can be family offices, and it also can be your network of entrepreneurs that you work with, high net worth individuals. And I do see that more and more with emerging manager, where actually, over 10%, sometimes even 20% of the fund is coming from friends and family, high people from your network and very close network. Most of the LPs that I speak to and convert for first close and first time fund are actually family offices and specialist fund of fund. But after I'm also more specialized in private equity and venture capital. So I'm less likely to bring a pension fund. That's been said with pension fund. Actually, it's a good point. It's U.S. pension funds. If your strategy resonates well with the U.S. market because the fund size is sufficiently large for a U.S. investor to consider you, then U.S. pension funds do have for a certain number of emerging manager program, and they are looking actively at first-time fund. After, yes, development financial institutions and funds like EIF and BPI in France, or the British Business Bank, etc., are typically, good institutional investor to go to early in your process for first-time fund and first closer LP as well.
Lovely, thank you. And now I would like to turn our attention to a very specific type of LP, a family offices. A family office is often approach investments with a very different process and priorities than institutional LPs, and later there are some that do have very institutionalized process. So Valerie, what are family office investors typically looking for when they engage with the fund manager?
Family offices intends to be really highly relationship driven. So they need to be able to connect with you and your story. They also want to be seen as a strategic partners to you. Can they add value to your strategy? If you offer them some co-invest, can they help you and assist you with that? I've seen family offices that, once they have the conviction and the belief that the team will execute on what they're looking for. I have in mind some family offices who've been looking at, the defense sector. And I know the defense sector is coming now to be a little bit more popular, but a couple of years ago it was less so, and some of the family offices I was speaking to really told me, Valerie, if you come across some good manager with a strong expertise in defense, will be interested. And sometime when you bring something that they're really looking for, they can definitely be super helpful. If you're an emerging manager, they can warehouse sometimes deals for you. So that means if your fund is not yet ready and your first close is not yet in sight, but you do have access to some deals opportunity, then they will. Some of them can actually warehouse deals for you, so they can invest on your behalf, and then you can transfer the deals to the fund and get you going. So family offices can be really, really strategic partner to you. The process tend to be faster than for most institutional investors. So some institutional investors need to follow you and have a process that, it's like 6 months, sometimes more. Family offices can take sometimes a few weeks. They don't have, some institutional investor would tell you I have one investment committee every quarter. Family offices, you intend to have a really quick decision maker. So often is either the CIO or a member of the family. So the decision can be very quick if they like you. And then once they're on board, they intend to be quite light touch in terms of information requirements and reporting. They're much more interested in having informal and ongoing sessions with the GP.
Thank you. And now I would like to move to another important topic. We often see recurring pitfalls when first-time and emerging managers go to market. Valerie, in your experience, which are the typical common reality pitfalls, and which one of the pitfalls is the hardest to overcome? Building credible track record, attribution, achieving institutional platform readiness, or securing an anchor investors, and why?
I have to say the most common reason a fundraising will fail, and it's because of the inconsistency in all the documentations and the storytelling. So it's like I always take the metaphor of peeling the onion. So so if you think about an onion, you have an LP who's interested, you give them the, your high level investment strategy and who you are, etc. They like the first introduction meeting. They want to dig more, and they start peeling the onion, and then they realize actually your I don't know, your past track record, it doesn't quite fit with what you want to do now. Your what you tell me in terms of what you did in the past, actually, when I did my reference call, did not really match your role. You told me you were leading on all these deals, and actually in some of these deals you haven't led them. You were only there for the sourcing or just there at the end. The pipeline, you tell me you want to do these deals and you're not going to pay very much for them, and then I can see in your pipeline there's some quite rich potential valuation, or you saying that most of your deal you will source because of your own network, and they will be bilateral. And then when I look at your pipeline and we discuss your pipeline, there's I don't know, 1 or 2 deals who are proprietary, and then there's 6 or 7 which are through limited auction or auction. So is this inconsistency that will get LPs to backtrack and lose the basically your momentum on the fundraise? The other things that sometimes you have a really good meeting with an LPs, you can see there's a fit, you can see there's interest, he's super engaged, and you get excited, and suddenly you overpromise during your pitch. You're saying, yes, our portfolio is doing very well, and we expect to exit this year, and actually realistically is only 1, and these 2 exit, they're going they're in process, and in 3 months time they should complete, and again it takes not 3 months, but it takes 6 or 10 months for this exit to realize. And when these kind of things happen, and mismanagement of expectation and over promising, again you lose your momentum, because an LP will say, oh, okay, you're expecting an exit, that would be great, because I want to see more exits in your portfolio, so let's reconvene once these exits happen. And if you told them it's in 3 months and it happens only in 10 months or longer, then obviously you have difficulties going back to that particular LP. Over example, and someone touched base on it earlier. I can't remember if it was Daniela or Anelia, but sometime in fundraising you lose focus. We think, and that's what Mirna, you mentioned, you think about the first work stream where you just concentrate on the LPs meeting, and you keep meeting LPs. You want to meet more LPs, you go to all the conference, and then you lost track of who actually was interested in you. What did they say? Did they say to reconvene in 3 months? Did you reconvene in 3 months? Did they say let's touch base once you, I don't know, recruited that mid-level person that you told me you were going to recruit, so I want to see more people in the team, so let's reconvene after that. So what I do see often is GPs who just want to keep meeting LPs until there's one that converts, rather than focus on those who have expressed interest and those where there's a proper fit, but you just need to work alongside them and bring them the information they need to convert them. And converting an LPs is not just meeting one person once or twice. It's meeting an organization, right? So you will need to meet several people there. They will need to come and see you and do some due diligence. I think I had some stats from where I was at Triago in terms of the number of interactions that we had on average to convert an LPs, and it's more like 30 to 40 interaction, 30 and 40, rather than just 5 or 10. So it takes really time to focus on this LP to convert them. And then you need to understand when to push, i.e. when you want to push an LP to make a decision, and when to wait. If you push them too early, you're most likely to have a decline on someone who you could have potentially converted later on. So it's always a fine balance of tactics in your fund, in your fundraise, and of course when you have inquiries, and you're doing all your meetings with LPs, then sometime when you receive a due diligence questionnaire from an LPs, yes, you should not go back to the LPs a month later. It has to go back to that LP within a few days, and it takes time. So you just need to be really, really focused once you have a pool of LPs that you have identified that could be interested in your strategy. And maybe for more emerging manager especially, often it's when you fundraise, you need to prepare for a marathon, not a 200-meter race. So you need to pace yourself, and don't underestimate the time and the work that it takes. I mean, we mentioned the statistic earlier on, and I think it was Anelia who mentioned that, yes, the fundraising at the moment takes definitely 18 to 24 months. So be prepared, and don't launch too early, because that's also when you if you're not ready, then you have one chance to impress, and you should not miss it. So just launch when you're ready. If you have momentum and people say, okay, give me access to the data room, and you haven't, it's going to take 2 or 3 months. You can't go back to that LPs, after 2 or 3 months, they've forgotten about you. So that would be my my common pitfall. There's quite a few there, so sorry about that.
Yeah, thank you so much, Valerie. And I see that there are new questions coming in Q&A session, and I would like to encourage everybody to post a question. We will start answering these questions in about 4 minutes, the latest, perhaps even sooner. Before we do that, I still have a very brief question to Valerie, and I would like to ask you, what makes the fund manager stand out in the first 5 minutes? So what do you think, Valerie? What makes the difference in these first 5 minutes?
So again, the first few minutes of the meetings are crucial. You need to grab their attention. You need to make them want to hear the rest of your offering. So you need to be working on your elevator pitch, your 5 minutes introduction, if you like, to make it really clear, concise, so they are able to understand, what you're here for, what you do, who you are, and why, why they should consider you. The other things is, like, sometimes I also see emerging manager, especially, they have this elevator pitch and they rehearse it, and then it doesn't come across naturally. So you don't have the passion anymore and the belief in that come across. So you always have to remember that, especially when you pitch, there's some statistic and there's been some studies around it, but basically 50% of a pitch is about the content and 50% is about how you deliver it. So have energy, when you meet LP and show some enthusiasm. LPs do in the first 5 minutes, they do need to get what you do very quickly and be able to process it. And maybe I can just explain one way to do it, and it's not the only way, but one way to do it is to dissect your mission statement. So you take bit by bit, like, I'm I don't know, I'm a lower mid-market manager focusing on the UK market, and I believe in technology enable opportunity for the energy transition. Okay, so what do I mean by lower mid-market? Why do I mean by technology enabled for the energy transition? Why the UK, and why me? For delivering on that mission statement.
Mm-hmm. Okay, and I think now it's really fair that we take some questions of from the audience. Yes, I can actually ask my colleague Giovanni to read the questions. If you would like to join and read the questions, please.
Yes, absolutely. So we do have a question from Paul Adrian on what is a reasonable fund size for a first-time fund targeting secondary investments such as scale-ups, and what would be a well-calibrated ticket size. And then we have one question from Priyanka on how soon after final close of a fund should GPs look to raise the next fund. And I'm going to read a third question, and then I'll let you both of you answer. And then one more last is, was the amount of new funds failed versus survive, by Ugo.
That one last, I don't see the last question really. What is the amount of?
Failed fund, new fund that have failed versus that succeeded in fundraising, or like first-time fund managers.
It's really, I think it's really hard to get. So if we start with the last one, I'm not sure there's data about fund failure, because most of the time you don't know about a fundraising that obviously hasn't come through. I have to also mention here is, you may start with the ambition of raising a fund, and for whatever reason, it's not the right time, or it's taking too long, or you can't get the momentum, or it's not quite right. There's alternatives for nowadays for raising a fund, which is this deal by deal fundraising process. So if you have access to some deal opportunities, there's more and more LPs that are willing to back you on a deal-by-deal basis, or provide the equity for a particular acquisitions that you're looking at, and that's allow you maybe to strengthen your track record, or build a common track record between the team, and show or articulate better your strategy in terms of really what you're looking for, and you can explain it concretely with some example. If I go back to the first question, Giovanni, was reasonable fund size for first-time fund. There's none. The answer is like he ranged from, I think the largest, and I'm talking private equity, the largest first-time fund that was raised last year was the US fund, and I think he was 2.5 billion. I would not recommend it personally, but there's no there's no right and wrong. I do see also some mini funds being raised, like 25, 30 million. So everything is really dependent on your portfolio constructions. What you need to take into consideration is how many deals can you do with the bandwidth that you have, because usually you are building up a team in parallel of raising a fund. So how many deals can you actually do, and what's your average ticket size for the deals, and that will give you an answer for your fund size. There are certain LPs that won't be able to invest in smaller funds because they have a ticket size who are quite meaningful, and so let's say they have a ticket of 40 to 50 million, and they can't be more than 10% of a fund. So yes, if you're targeting 100, 150, you know that this LP can be part of your target. But there's no rules. I mean, I've seen funds of 25 million who do really small deals, and then raise second fund which is larger, and also you can do more concentrated portfolio to start with, to allow you to get going, and then raise another fund, second fund slightly quicker than normal. So there's no rules, but your portfolio construction needs to make sense. You need to be able to justify why you decided on a particularly fund size target. And then on this, actually, LPs will also look at your GP budget. So they say, they would say, if you're, I can see your plan is to have a team of, 10 people, but you are targeting a fund size of, 60 million. How are you going, what is your GP budget for the management company? Because not sure that fit. So you need to make sure, again, on this onion peeling, that everything hangs together. So your fund size has just to be right, depending of, the number of opportunities you want to do, and the size of the tickets you want to invest per opportunity. And then the other question was, how soon after your final close can you start fundraising? It really depends. I mean, you have an investment period usually of, especially for private equity or venture funds, of, roughly 4 years or 5 years. You can make it shorter. And it also depends on, how long it took you to fundraise, because often what we see, or start as saying it takes you on average 18 months to 2 years. So by the time you had your first close and by the time you had your final close, that means your fund may already be quite well invested. So you may already have, made, 3 or 4 investment at final close, or even more, out of 8 that you want to do. So already half of the fund is invested. So that means you're probably going to come back to market within the next 2 years, so quite quickly. So again, there's no rules. You have an investment period. What LPs will be cautious of is also that you make sure that your portfolio construction is diversified by vintage. So you don't do over deals on year 1 or 2. If you have a 5 years investment period, they want you to pace your investment, your investment across the investment period, for diversification, because we know there's sometimes markets prices are higher, sometimes they're slightly lower. So we just want to make sure you have diversification as well across vintages. So no real rules there, but I would say not before 2 years, right? Your final close, you need to allow 2 years to go back to LPs, because they also want to see how how the portfolio is performing. So you need enough time to show that the companies have been growing, and then you have a strong case for your fund too.
Lovely, Valerie. I just want to mention one thing. As we are sort of maybe running out of time to answer all of the questions in this session, all of the questions will be answered through the Knowledge Hub, or Empowering Equity flagship program of the European Investment Fund. You will also get a quick link to the survey so that we'll try to answer all the questions. And I just want to just quickly touch base on the Ugo Tomasello question. The success of the first-time teams, we do not have the actual data for the success, but we do know specifically how many first-time teams actually managed to fundraise successfully. And these statistics is shown in the presentation, which will be shared with you. And I can tell you, it is about 1/3 of 25% of the total fundraising in the number of funds for the venture capital, and less than 10% for the more established strategies such as private equity. And yeah, I just maybe wanted to answer to Priyanka Shashira, how soon after final close of the fund should the GP look to raise the next fund? That truly actually depends whether you already have an established fund manager franchise. You're raising like fund 5, fund 6, then usually you start fundraising in a year 2 to 3 after the final close. But if you are a first-time fund manager, you may need to build the momentum, close the investment cycle, have 1 or 2 exits before building credibility. Because if you have established a machine, the time cycle shortens. And in terms of answering the question regarding the pool, Adrian, what is a reasonable fund size of the first-time fund targeting secondary investments in scale-ups? You know, if you're talking about the scale-up financing, which in Europe would translate into 20 to 50 million ticket per sort of a scale-up funding, and you need to have at least 5 in the portfolio, then you can do your math. But it's going to be super difficult to raise more than 200 million euro fund for a first-time team. Actually, most of the first-time fund managers struggle to raise more than 50 in the first closing. But then a strategy of co-investment opportunities, building a legacy portfolio, going deal by deal is a truly credible one. Okay, so I think, you know, we have time for 2 more questions. May I, may I ask Valerie the following question? Have you managed to convert an LP after losing them? And if so, how did you do it? Valerie.
Many times. That's the key tip here. Don't take a no for an answer. So obviously you need to understand, you know, that's why I explained, you need to understand LP say, this is really interesting, but I want to see, I don't know, I want to see the team being more built up. I want to see a little bit more deals in your portfolio. I want to see, you know, more exits from your first fund or previous fund or something. So just put note on that, understand their concern, and go back to them once you solve the concern. Go back to them. It's really important, and keep doing it until you get to the bottom of the declines, because sometimes you also have decline, you're not quite sure why. It's like, you know, this is interesting, but it's not the right time for us. Okay, what does that mean? So just keep going back to LPs, because as we said, fundraising can take 2 years, right? And sometimes even more. And things change at LPs. You know, sometimes it's because you're focusing on, I don't know, you're focusing on the Nordic, or you're focusing on France, and they just made an investment in France or in the Nordic. And before they can consider another one, they just need to do in investments in other areas and other countries of Europe, and they're not going to tell you that. So just keep updating them in a nice way, or having some informal catch up at conferences, or when you're next in I don't know, in Frankfurt where that LP is, or in London where that LP is. Just ask them, oh, I'm here. I know you. You decided not to look at us last year, but this is what happened since, and is it worth having an update? And you'll be surprised. A lot of LPs will give you that update meeting. And yes, I had, especially when I was at the GP, I think I had an LP that I converted to a final close, and it was a really meaningful LPs, but they declined me politely at least three or four times, so you just keep going back. So yes, you need a bit of resilience there, but you can't do that with everybody. You really need to have a reason to go back to them.
Lovely, thank you, Valerie. And as I said, unfortunately, we didn't have time for all the questions, but those will be answered a bit later during using the Knowledge Hub. And before we close, we would really love to hear from you. If you have learned something new today and what you found useful and interesting. I would also like to use this opportunity to announce our next masterclass, which will take place on the 24th of March, where we are going to focus on due diligence. You will receive full details, registration information, and preparatory materials shortly, as well as the presentation that has been shared during today's delivery, as well as the annex slides, which contain some more detailed background statistics and few more useful tips and tricks for successful fundraising. With that, I would really like to thank my co-facilitator today, Valerie Offrey, and I would like to move to the contact slide, please. If I can say, Valerie Offrey can be reached on her email, valerie@corwellpartners.com. This presentation will be shared together with the email details. And if you would like to reach to all the Empowering Equity team, please use a dedicated email, Luxembourg Empowering Equity at PwC Luxembourg. Let's now go back to the previous slide, just to make sure that everybody can scan the QR code, and we greatly appreciate anything that you can provide us in your feedback. Please do that. Thank you so much. And with that, I think that we can confidently end this masterclass session. Thank you all very much for participating. Thank you.